Good evening, everybody. I'm Sue Herrera in for Susie Garib, who has the evening off.
And I'm Tyler Matheson. Welcome, everyone. Well, it was another record-setting day on Wall Street with investors getting a boost from some good news about jobs. Just one day ahead of the February jobs report, probably the best measure of economic growth and stability, first-time jobless claims tumbled by 26,000 last week. They fell to a three-month low. And an outplacement firm reported that planned corporate layoffs declined by 24% from February of last year. Not even a dip in factory orders last month or a slowdown in fourth quarter worker productivity could really derail today's rally, at least not much today. On Wall Street, the Dow finished 61 points higher. The Nasdaq did stumble slightly after spending much of the day in the black. It ended down 5 points, and the S&P 500 edged just 3 points higher today, but that was enough to end the session at a fresh all-time closing high of 1877.
All right, joining us now to talk more about the markets is Kate Warren. She's investment strategist at Edward Jones. Good to see you, Kate. Welcome back.
Thank you.
Let's start, first of all, with what you're expecting in the jobs report tomorrow. Where is your number, and specifically what in the report is going to be the most important for you?
Well, we're certainly looking for a total job creation of around 145,000 and the unemployment rate to stay at 6.6%. But the things we're really going to be watching, in addition to that headline number, which I think will be what everybody is watching, are what happens to part-time workers, what happens to wages, with the idea being it's the details that are also giving us some comfort that the economy is continuing to improve, even though the headline number the last couple of months has been pretty weak.
You know, Kate, there are always plenty of things to worry about, whether it's the economy or the unemployment number or the Ukraine or emerging markets or whatever. But what is your outlook for the U.S. stock market in 2014, and what would you be advising investors to do?
Well, our outlook is pretty positive. We think volatility will increase so that we'll see more fluctuations, but we think the trend is higher because we do think the economy is improving, although not dramatically, just somewhat. We think earnings will continue to rise in mid-single digits, and we think the global economy is improving as well. That synchronized global rebound actually will give a boost to U.S. markets, so we think stocks will move higher. That means that we think investors should be adding stocks if they need to in their portfolio. But the most important thing to do right now is to be sure you've got the right mix of stocks and bonds. If you had the right mix a year ago today, after a 30% rise in U.S. stocks, you may actually need to be adding fixed income, even though we think stocks will continue to go higher and are good investments today.
Are there specific stocks that you think might be still a very good value in this market?
Yes, we think that investors need to be a little more selective, and that a good place to look are companies that are benefiting from the stronger economic growth. In that, we'd be looking at companies in the technology area, in industrials, and we'd be looking at companies and in energy, and we'd be looking at companies specifically like Devon or EMC, companies that basically are going to benefit from that stronger growth.
Let's talk a little bit about the global situation right now. How do you filter into your outlook what's going on in Ukraine and the particular issues that have been confronting several of the emerging markets, whether it's Turkey, Brazil, or others?
Well, certainly to start more broadly with emerging markets in general, many countries have specific problems. They have large current account deficits, they're importing more than they're exporting, they have budget deficits, and they have falling currencies, partly due to the fact that China's growth has slowed, and in many cases, they're commodity producers and they're selling less. So we think that across the board, emerging markets look pretty risky, and we'd be keeping those to less than 5% of your portfolio. Ukraine in particular is sort of a different issue because it's really been a concern because people are worried that we'll see a military escalation. We don't think that's likely to occur, but it could certainly roil markets again, and that's what we saw Monday. We think that's calmed down a lot and is probably going to stay calm, even though the politics are unstable, and we don't really know what's going to happen diplomatically or even where there could turn into a military situation again.
Kate Warren, thank you. Before we let you go, any disclosures about the stocks that you mentioned to us?
I have a family member that owns EMC.
All right. Thank you, Kate. Good to see you again.
Thank you. Nice to see you again.
Investment strategist over at Edward Jones.